Hello, Bullish Bears. By popular demand, I've been asked to make this video explaining my version of the wheel trade strategy. And it's a modified version of the strategy. And if you've read the article that I wrote for the Bullish Bears a while back, you get a vague idea of how to do it. On paper, it doesn't always come across as easily. So I'm going to walk you through step by step what I've done here with Camber Energy. CEI is a penny stock currently trading way less than $1. It's trading, I think, 82 cents, something like that, whatever. Doesn't matter, because I'm going to show you how to acquire this position for zero risk. And at some point, your cost basis will be negative. And if at some point your cost basis goes so far negative that it's negative 100%, then your position is absolutely risk-free. So let's walk you through that, and I'm going to show you the basic idea of what it takes to get to zero and what it takes to get to well beyond zero. I have equities that I've been doing this with for years and am negative almost 10 times the current share price on a couple of these. And all it takes is something with liquidity in the options. You have to make sure that these options are actually trading. You have to also make sure that there's plenty of volatility in the price action to make the premiums swing up and down and provide you price action to take advantage of the premium. And not only that, you want to be able to take advantage of the price swings in the premium itself, so that you can essentially sell to open contracts and then buy them back for less than you sold them for to close them. And then if price action goes in your favor again, you can then sell the same contract over again for more than you paid to buy it back in the first place, and rinse and repeat over and over again, just taking advantage of a little 5 cent, 10 cent, sometimes 15 and 20 cent swings in the contract value on these contracts over and over and over again. And there's also a way you can do it without day trading. If you sold a contract to open it on one day and the next day you bought it to close it, you can then sell it again to open it on the same day, and it does not count as a day trade. So you can do this process daily, and you can flip these contracts over and over and over again as long as you've held them overnight. So let's get started on my log here, and I'll explain what I've done to achieve a zero cost. And then at one point recently, it crossed below zero. Currently, I'm negative 9 cents a share. How does that happen? Well, this is going to be the icing on the cake for you, because this is how the awesomeness works. So, entered my position on the 24th of February at 84 cents a share. And currently it was trading at 82 when it closed on Friday, whatever it was. So I'm underwater on my initial entry, but I'm not. Okay, so bought all the shares to be in this position, 84 cents a share. On the same day, I sold to open a February 25th expiration $1 put. That's a put that expired the next day, okay, at $1 strike. I sold it for 30 cents a contract, meaning if I get a sign on these puts, my cost basis is just 70 cents a share. I'm already winning, because that 70 cents a share will offset the 84 cents a share that I already paid for entering the position, and also double my position so that I can profit from those shares if they're anywhere above my cost basis on assignment. And that is important. Ideally, you want to avoid assignment if you can, but if you are assigned, it's not a big deal, especially if the share price is above your cost basis. You can profit those shares, cut your position down by half, and reserve the cash to re-enter the position later by selling another put or another 100 puts, or however many you want to do. Ideally, I'm going to say this right out, you want to practice this trade style, this trade strategy, with just one contract, 100 shares. Start small. I don't care if you have $1 million account. Start small and get used to the process before you go and take big risk in this. And that's why I'm explaining this process on a penny stock to begin with, because ideally, you eventually want to be using this same strategy on blue chips. You want to be using this if you're got the cash, do it on Amazon. If you've got enough cash to do this on SPY, it's pretty good income. Nvidia is a really good one because the premium is through the roof. Tesla, if you got the scratch, you know what I mean. Essentially, you want to learn this process, learn this strategy, and then apply it to other things. And if you've got the risk appetite to do so, as long as you can double your position and comfortably enter it and hang on to it for a long time if you have to, sit underwater if you have to, whatever it takes, eventually you're going to reduce this cost basis on that position by generating income from the options. Let's get to the next part. So over here in my log, also on the 24th, I sold to open a, let's see here, a March 4th $1 covered call on my position that I held at 30 cents per contract. Meaning if this was to be exercised, my profit on that, or my break even on that, would be $1.30 per share. So if someone was early assigning me or something like that, my cost basis of 84 cents less the put premium that I made here would be essentially the gap between my cost basis and what I sell these shares for under this contract. So a call, again, if you don't know, is essentially you're selling a contract agreeing to share or sell 100 shares per contract at the given strike price. So in this case, it's a $1 covered call, and if for some reason this thing went to $100 a share or whatever, I'm still obligated to sell those shares at $1 per share. So charging a premium for that privilege is where we make the money. So essentially selling that privilege at 30 cents a share, I'm already well above my cost basis, so I can profit that. I wouldn't care if I got a sign on something like that. No big deal. The next thing I did, the very next day, I was able to buy to close. That's what BTC stands for. That same March 4th expiration $1 covered call, I was able to buy it back for 5 cents per contract. So the difference is I pocketed 25 cents per contract, or $25 per contract, and reduced my cost basis on my original entry of 84 cents a share by 25 cents a share in doing so. So that took my cost basis down to 59 cents a share. That's the next day. All right. Also on that day, I was able to sell to open a March 11th expiration $1 covered call for 10 cents per contract. And also, I noted in here that on the 28th, I was assigned on my cash covered puts, and that is where my 70 cent per share cost basis is reflected there. So that adjusted cost basis went up from my 59 cents a share, obviously, because I was being assigned shares at 70 cents a share cost basis. So it brought my cost basis back up a little bit, 64.5 cents a share. Okay, no big deal. I'm still well within my means. Not a problem. I'm still reducing cost basis. So let me do a little more fine adjustment on this. On the 28th, upon that assignment, I was able to sell those shares into the market at 77.5 cents a share. So I made a 7.5 cent per share profit on those assigned shares. That is a capital gain on the position that I was assigned, and therefore that also will offset the cost on the rest of my remaining position, because I only sold the shares I was assigned, or the share count I was assigned. So it brought me back down to 57 cents a share. On the 28th, I also sold to open a March 4th expiration $1 cash covered put at 31 cents a contract. Then over here, a few days later, I was able to buy to close the 3/11 expiring $1 cash or $1 covered calls at 2 cents per contract. So having sold those up here, where was it? Right here at 10 cents a contract, buying back at 2 cents a contract. That's an 8-cent difference, so that reduces my cost basis by another 8 cents a share. Let me walk you through the rest of this here. So where was he? Okay. That reduced my cost basis to 49 cents a share on my existing position. On the 4th, I was also early assigned. And that's where you get assigned on contract before it expires. And they expire at the end of the date that they are expiring on. They expire at midnight officially. So any time between 1 a.m. and midnight that calendar date, a person holding that contract can just assign it. So they can execute it, and I am obligated to purchase those shares at that strike price. So in that assignment, since I had sold that put contract set for 31 cents, as I sold to open, 3, 4, $1 puts, 31 cents contract, my cost basis on those assigned shares, let's see, where did I have that? Early assignment, my cost basis was 69 cents a share. So my adjusted cost basis went back up from 49 cents a share to 59 cents a share. Big deal. Not too worried about that still, because I was still under my entry. Not a problem. On the 7th here, I profited, which was the following Monday, I profited those assigned shares at $1 a share. So that was a pretty good situation when I was assigned there, because I was assigned at 69 cents cost, was able to sell them at $1. That's a 31 cent per share profit. Pretty nice. So that offset my cost basis from 59 cents a share to 28 cents a share. So every time I'm assigned shares, doing whatever the hell I can to make sure I sell them over what my assigned cost basis was. You won't be able to do that all the time. Sometimes these stocks can be so volatile that they come down well below your cost basis, and you end up assigned at a slightly higher cost basis than the share price is trading. And if you end up stuck with those shares, you might have to sell them at a loss to just make sure that you're taking your risk back out. And then you can just do the math and adjust your cost basis on your existing long position. So it does happen. In this case, I got pretty lucky because I was also paying attention to the chart and noting that the price action was still working within my favor. It spiked up here to $1.98 a share on this wick up here. Yeah, there's plenty I could have did to make a whole lot more profit on this, but this is a strategy that you can do when your life is busy. So like if you're like me and you're running errands, you're working a day job, whatever, you can kind of not have to stare at the screen all the time and watch this position. You can just set limit orders, or if you happen to notice it, or set alerts, whatever you got to do to take advantage of when you can. You can make this trade, even poorly managed, this trade strategy does very well. So anyway, continuing on here, where was I? Adjusted cost basis on that 28 cents after profiting those shares at $1. Okay, so on the 7th there, I sold to open another 311 set of $1.50 strike covered calls. Okay, that was on the 7th. Looking over here, that is when the price made that really nice push. Where was I? Right there. So that was when the price pushed to about $1.40 a share. So I was able to sell a $1.50 strike instead of a $1 strike that day, and I sold it for 18 cents a contract. Pretty nice. My cost basis is still really stinking low. It's at 28 cents a share. So I was able to buy to close those contracts on the 9th at 7 cents per contract. And on the same day, I also sold to open that same contract, that $1.50 strike, for 10 cents. So in the same day, after holding overnight, or a couple days, buy it back at 7 cents and then resell it later in the day at 10 cents. So I'm only changing my cost basis offset by this difference between the 18 cents and the 7 cents per contract. So that brought my cost basis down to 17 cents a share. On the 11th here, I was able to buy to close that same 311 contract, $1.50 strike, for a penny, or $1 per contract. So I took that 10 cents and made 9 cents back. That reduced my cost basis from 17 cents a share to 8 cents a share. Pretty damn cool, right? So as time goes on the 14th, I was able to sell to open $1 strike covered calls at 11 cents per contract. The very next day, I was able to buy to close those same contracts at 7 cents. So that's another 4 cents off of the 8 cents, meaning cost basis is now 4 cents per share. That same day, I was able to sell to open that same $1 contract for 10 cents per contract. So the following day after that, buy it to close at 6 cents. So there's another 4 cents off. And guess what? My cost basis was 4 cents a share, and I made 4 cents per contract on that. So my cost basis is now 0. On the 16th, I was able to achieve 0 cost basis after entering on what, the 24th? Not too bad. Under 4 weeks, I was able to get to 0. Pretty sweet. So another thing to think about in this situation is also going to be critical about what broker you use to execute these. I use Robinhood to execute these. I use Webull for all my charting, my day trading setups and stuff like that. I also use it for my chart analysis because Webull just has killer charts for free if you open an account with them. But Robinhood has 0 commission on anything, including options. So I'm able to basically have all the money that I get for selling premium and keep it. I don't have to pay my broker their cut. So it's really easy to take a situation like this and turn it into a 0 cost basis when you're using a free broker. I know a lot of people kind of talk crap about Robinhood, and yes, I've gotten into situations with Robinhood where they've really pissed me off by doing stupid things. Happens, but this strategy, they can't really screw me on this. I win. So on the next day, I was able to go and sell again another $1.50 call, okay, on the 23rd. So let's look at that on the chart real quick. So on the 16th, I was able to buy back that dollar covered call for 6 cents. Okay, so the 16th is, let's see here, over here, 14, 15, 16. It's trading around 78 cents a share. It stayed there for most of the day, whatever. Pretty flat day on the 16th, okay? So let's get back to, let's see here, the 23rd, where I was able to sell those $1.50 calls again at 14 cents. Let's see here, here's the 23rd over here, and price spiked at about $1.05 a share. So I was able to sell $1.50 contracts again, which is pretty cool because, you know, it's still trading right around $1 or less. Anyway, sold that $1.50 contract at 14 cents. And I also sold a $1 cash covered put expiring on April 14th for 24 cents. So let's see here. A couple days later, on the 25th, I was able to buy to close that $1.50 call at 9 cents. So that reduced my cost basis by 5 cents a share, bringing me to a cost basis of negative 5 cents a share. My cost basis is below 0 at this point. It doesn't mean my risk is below 0 because anytime I sell a cash covered put, like I said, you're going to be doubling your position on assignment. And if you are assigned, you take your negative 5 cents a share and you add your assigned cost basis, so the strike less the premium that you sold it for, and you're still going to arrive at a pretty low number. So it won't matter if you're assigned on a $1 call. It's not going to really sweat it as long as you got some premium for it. So anyway, on the 30th there, I was able to sell to open. April 14th, another covered call, 12 cents contract, $1 strike. I also sold the cash covered puts, same expiration, $1 contract strike price, and 24 cents per contract on that. Let's see here. On April 1st, which was Friday here last week, I was able to buy back that cash covered put at 24 cents. It didn't really move. Price action was kind of crappy. Didn't do a lot of good for me. You can see that it was trading in a range right around the cost basis for that, maybe a little higher. So the contract didn't move enough to really make any money on, but I didn't want to carry the risk over the weekend because I think this consolidation is very likely to give us a little bit of a pop back up to resistance, probably around 87, 88 cents a share on Monday, maybe if things go right. It can also come down and find range, I don't know, around 80 cents a share, or even pop down to like 79 cents a share. Whatever the price action does, I will trade accordingly and either sell covered calls and sit on those, leave the puts out of the picture for a minute, or if price comes down, I'll sell the puts and take advantage of that. And if I can, I'll have a covered call open too. So anyway, I closed both positions. I left just my share position, my long position, closed both the contracts down, and in the process I was able to buy back that covered call that I sold for 12 cents for 8 cents, so reducing my cost basis another 4 cents. It took me from negative 5 cents a share to negative 9 cents a share. And I can keep doing this for as long as there's volatility in this particular equity. So I'll probably continue doing this up till they get news that they're going to be, delisted if they don't get their share price over $1 or something like that. So I kind of got to pay attention a little bit to some news issues that may arise and be conscious of my long-term position. So doing this in a penny stock, you kind of got to be a little bit on edge. But realistically, I have an open position, no contracts open, and my cost basis is negative cents a share. So negative 9 cents a share. If this thing goes to zero, I've still made 9 cents a share profit on this situation. No big deal. I could profit the shares now and take on, a really nice profit. Could do that as well. You can do anything you want with this, but as long as you've practiced the process, that's the important part. Use your penny stocks for that purpose. So I might continue holding this for probably a few more months. As long as there's volatility in the price action, I'll be able to sell contracts and profit from them over and over and over again. And now that I've gotten to my first milestone of bringing this down to a zero cost, I'm going to see if I can carry this on and take it to a negative 100% cost, meaning if it's trading at 85 cents a share, I want to be negative 85 cents a share. That'll be some glory and something to speak about. So stay tuned, and I'll produce another video and let you guys know how that's going. In the meantime, if you've liked what you've seen, if you've learned from this, if you think you can use this strategy, practice this strategy, great. Subscribe to our channel and give me a like. I'm kind of brand new at making YouTube videos, so I'd appreciate some likes. Give me a dislike, ask me questions, whatever. Give me some input. I love this stuff. But at any point, I'm trying to teach this strategy to people so that they can learn how to make income from their investment positions. What's cool about it is when the wheels start turning and you start getting some experience and you can really take control of your portfolio in ways that you never imagined before with this particular strategy, you'll learn that you can sell options in your IRA. You can generate income within your IRA using this process for any of the large caps that you're holding. I mean, even if not many people are holding penny stocks in their IRA, but you get the picture. Or you can take advantage of stuff like AMD is a great one to trade this process on. NVIDIA, a lot of tech stocks are going to be high premium for weekly options, and you can do exactly what we did here with CEI and just kill it. Before long, it'll probably take you a little more than 3.5 weeks to reach a 0 point with a large cap, but if you're persistent and you just trade the process and you keep taking advantage of price action, volatility, and everything you can in the options contracts, you'll eventually make that a free position. And who wouldn't want, a free position in AMD or NVIDIA or just any of these tech stocks that can just be completely volatile yet very unlikely to be bankrupt tomorrow? Just saying. Anyway, thanks for tuning in, guys. I'll be explaining a lot more of the strategies I've written about. I've written many articles for the Bullish Bears blog. Be sure to check that out on our Bullish Bears website. I've written quite a bit of material in that blog. And if you request in a comment or something, I'll be happy to send you links to everything I've written. And I've written about a lot of different option strategies you can use to just kill it in the market. And I'm happy to let you guys into my stream. Sign up and give it a try. We got the free trial still going for, I think it's a 2-week free trial or something like that. Check us out. You'll really like what you get with the Bullish Bears. You'll like being able to learn things that you would never have imagined is possible for option strategies. There's a lot of great options instructors in our group here. Great teachers, people that are personable, down to earth, or people too. And you're going to get a lot of input that you can ask questions. You can go into any direction you want to go with any strategy you want to go. You can go learn how to day trade price action. You can learn how to day trade futures. You can learn how to swing trade. And this is more of an investment strategy, but it's also something you can use all of your day trading and swing trading skills to operate this strategy. Anyway, that's it for now. I'll see you guys next time I make a video. Have a good one.